Welcome to ETF Leaders, powered by New York Stock Exchange. I'm Lara Crigger, Editor-in-Chief of ETF Trends and ETF Database, and I am here with Brian Kelleher. He is the Chief Revenue Officer at Simplify. Welcome.
Thank you. It's a pleasure to be here.
Glad to have you. So, lots of challenges facing investors in 2022. What do you see as the biggest ones, and how can investors manage their risk?
Yeah, there's definitely major challenges out there. So inflation, everyone's talking about inflation. The impact on investments within portfolios, what will inflation do that? How do you protect about it? So, managed futures is a great way. We have a great solution there with CTA. Rising interest rates, rates volatility. This is something that for 30 years, I think people have taken for granted. Like, there's the real potential, and it's happening in real time. You're seeing the curve really doing different things. And people worried about kind of how their bond positions in their portfolios are going to be impacted by rising rates. So having some way to hedge that is something that we've been able to bring to market with Simplify's interest rate hedge strategy, PFIX. And then lastly, there's a real potential for equity volatility, for potential for major sell-off in equity markets. There's just a ton of risks out there, including rising interest rate inflation, but geopolitics as well. So having different ways to protect the equity portion of portfolios with different hedges built into exposures is something we're really focused on.
Well, let's drill down into that a little bit more. Why is it so important for advisors to be hedging their clients' portfolios, and how should they be thinking about doing it?
In major market sell-offs, you find that asset classes that don't seem correlated tend to be correlated, right? So, when you've built this very nice portfolio of assets that look like they're all different, and all of a sudden they're all selling off together, it can be catastrophic for investors. So the idea of having real, true, non-correlated assets in portfolios that are going to perform in that market, perform differently than the rest of the portfolio, and ideally offer some downside mitigation is critical. And one of the things with hedging is you've got some phenomenal tail risk managers out there in the alternatives world, structured products world. A lot of wonderful hedges can't survive bull markets. So what we've done is really focused on building those hedges within different types of exposure on top of the beta. So the beta is going to perform ideally, and then we'll have the downside mitigation with that the tail hedges can provide.
Makes a lot of sense. So you have a number of ETFs in Simplify lineup now. Do you have a favorite?
I do. Most investors I find have a tremendous amount of exposure to U.S. equity, U.S. large cap equity. So that's the biggest part of people's portfolios that they should really think about insulating. So for me, SPD, which is 98% core equity exposure, and then 2 to 3% annual budget of a portfolio of protective puts that looks to mitigate that downside participation in major market sell-offs. That's my favorite. It's a $500 million strategy now, and has become our flagship.
Well, that sounds like a really interesting strategy for the moment, definitely made for the moment. So thank you so much, Brian, for joining me. And this has been ETF Leaders, powered by New York Stock Exchange. Thank you for watching, and we will see you next time.